Hi, ladies and gentlemen. Imagine you could measure the price of a house, not in dollars, but in ounces of silver. Sounds strange, right? Maybe even a little old-fashioned. But here's the thing. For most of recorded financial history, people did exactly that. They measured wealth not against a currency that could be printed at will, but against something tangible, something real. And right now, in 2026, that old way of measuring is quietly sending one of the most interesting signals that serious investors are starting to pay attention to. So today, we're going to talk about something most mainstream financial shows completely ignore: the shifting ratio between silver and real estate, why that ratio matters more than the headline price of either one, and what a potential 2026 market pivot could mean for everyday people trying to protect and grow their wealth. Stick with me on this, because by the end of this video, you're going to see the housing market and silver in a completely different light. Let's start with something that happened not too long ago that most people shrugged off. You may have noticed that home prices stayed stubbornly high even as interest rates climbed. And at the same time, silver, the metal, quietly went on a little run of its own. Most people saw these as two separate, unrelated events. The housing market is driven by supply and demand and mortgage rates. Silver is driven by industrial demand and commodity traders. What could they possibly have to do with each other? Well, as it turns out, quite a lot, when you zoom out and look at the bigger picture. Here's the foundational idea, and let's break this down carefully. Every asset in the world is priced in dollars. Your house, your silver coin, your stock portfolio, your savings account, all of it is denominated in US dollars. And the dollar itself is not a fixed, stable unit of measurement. It changes in value over time, sometimes dramatically. So when the dollar weakens, when its purchasing power erodes, the prices of real assets tend to rise in dollar terms. Your house didn't necessarily become more valuable in any real sense. It might just be that the yardstick you're measuring it with got shorter. This is the core concept behind what economists call real versus nominal value. Nominal means the dollar price. Real means the actual purchasing power or the value relative to other real things. And when you start pricing assets against each other, like houses priced in ounces of silver, you strip out the dollar noise and see something much closer to the truth. Think about it this way. If you had to trade a house for silver, not dollars, but actual silver, how many ounces would it take? That number, that ratio, is what we're talking about. And historically, this ratio has moved in very predictable cycles. When silver is cheap relative to real estate, it takes an enormous number of ounces to buy a home. When silver is expensive, or when real estate has corrected, it takes far fewer ounces. And here's what's fascinating. At certain pivot points in history, that ratio has compressed dramatically, meaning silver holders found themselves with surprisingly strong purchasing power relative to real estate. We saw something like this in the early 1980s. We saw echoes of it around 2011. And the argument being made by a growing number of analysts in 2026 is that we may be approaching another one of those compression windows. Now, this is important because understanding this doesn't require you to have a finance degree. You just need to grasp one simple idea. When a monetary metal like silver is dramatically undervalued relative to a hard asset like real estate, there is a potential for mean reversion. Things tend to move back toward historical averages. That's not a guarantee. Nothing in markets ever is. But it is a pattern that has repeated across different economies and different eras for centuries. And the reason it keeps repeating has everything to do with the underlying forces that drive both assets. Let's talk about silver for a moment, because silver is genuinely one of the most misunderstood assets in the modern financial toolkit. Most people think of silver as just a cheaper version of gold, the poor man's precious metal. But that sells silver incredibly short. Silver is simultaneously a monetary metal and an industrial commodity. It's used in solar panels, electric vehicles, semiconductors, medical equipment, and defense technology. The global transition toward clean energy and advanced electronics has created a structural demand for silver that didn't exist 30 years ago. At the same time, silver mine supply has been relatively flat, and many silver deposits around the world are being exhausted. So you have rising demand meeting constrained supply, all while silver's role as a store of value continues to attract investors who are nervous about currency debasement. That's a powerful combination. And yet, despite all of this, silver has historically traded at a significant discount to where many fundamental analysts believe it should be, especially when compared to the price of gold and the price of real assets like housing. Here's something worth sitting with for a moment. The gold-to-silver ratio, meaning how many ounces of silver it takes to buy 1 ounce of gold, has historically averaged somewhere around 15 to 1 or 16 to 1 throughout much of recorded history. That ratio reflected the natural abundance of silver relative to gold in the Earth's crust. In recent years, that ratio has sat in the range of 80 to 1 or even higher. That tells you one of two things is true. Either gold is dramatically overpriced or silver is dramatically underpriced. Most analysts lean toward the latter, and when you extend that logic to silver's relationship with real estate, you start to see a similar picture. In terms of historical norms, it takes far more ounces of silver to purchase an average U.S. home today than it did in 1970 or 1980 or even 2000. That divergence is the opportunity signal that some investors are pointing to right now. Let me give you a simple way to visualize this. Imagine a seesaw. On one side you have real estate, an asset that has been inflated by decades of easy money, low interest rates, government stimulus, and constrained supply. On the other side, you have silver, an asset that has been suppressed in price by complex paper markets, a lack of mainstream attention, and a financial system that has largely moved away from commodity-based thinking. The seesaw is way out of balance right now. Real estate is high up in the air. Silver is sitting low on the ground. The argument is that over the next few years, and specifically around what some are calling the 2026 pivot, those two sides may begin to rebalance. Real estate could soften due to affordability constraints, credit tightening, or shifting demographics. Silver could rise due to industrial demand, monetary demand, or a shift in investor sentiment. Or both things could happen simultaneously. When a seesaw rebalances, the side that was low rises fast. Now let's talk about what the 2026 pivot actually means, because this phrase is getting used in a lot of financial conversations, and it's worth unpacking carefully. The term pivot in markets usually refers to a major shift in one of the key forces that drives asset prices, things like monetary policy, credit conditions, economic cycles, or demographic trends. In 2026, we have a confluence of several of these forces simultaneously, which is why a growing number of economists and market watchers are treating it as a potential inflection point. First, there's the monetary policy cycle. Interest rates, which were raised aggressively in the early part of this decade to fight inflation, are at a crossroads. Central banks are navigating the tension between keeping rates high enough to control inflation and lowering them enough to avoid a serious economic slowdown or a credit crisis. That's a delicate balancing act, and history tells us central banks often get it wrong in one direction or the other. A pivot toward rate cuts tends to be bearish for the dollar and bullish for real assets, including silver and, to some extent, real estate. But a delayed or botched pivot can also trigger an asset repricing that creates dislocations across markets. Second, there's the credit cycle. Many observers have noted that the U.S. housing market has been propped up in part by an unusual dynamic. Homeowners who locked in ultra-low mortgage rates during the pandemic era have been reluctant to sell because doing so would mean financing a new home at much higher rates. This has kept housing inventory artificially low and prices artificially high, but that dynamic can't last forever. As people are forced to move because of job changes, divorces, deaths, or financial stress, that inventory dam could begin to break. If housing supply increases meaningfully while demand is constrained by high rates and low affordability, you have the conditions for a price correction. That doesn't mean a crash necessarily, but it does mean a softening, and even a modest softening of housing prices combined with a significant rise in silver prices would dramatically compress that silver-to-housing ratio we've been talking about. Third, and this is the one that doesn't get enough attention, there's the demographic cycle. The millennial generation, the largest living adult generation in the U.S., is now well into their prime home-buying years. But many of them have been effectively priced out of the market. At the same time, baby boomers are aging and beginning to transition their housing, either downsizing or entering assisted living situations, which will release inventory over the coming years. These demographic shifts don't happen overnight, but they are real and they are predictable, and they tend to create meaningful transitions in real estate markets when they gain momentum. The period around 2026 to 2028 is when many analysts expect these demographic pressures to become more visible in the data. So here's what this all adds up to. You have silver that is historically undervalued relative to real assets. You have real estate that is historically stretched in affordability terms. You have a monetary policy cycle that could go in either direction, but both directions tend to benefit silver over the medium term. You have a credit and inventory dynamic in housing that is under pressure, and you have demographic forces that are beginning to tilt. None of these individually is a reason to make dramatic financial decisions, but together they form a picture that's worth taking seriously. And the concept of measuring houses in ounces of silver gives you a framework to track whether the rebalancing is actually happening without getting lost in the noise of dollar prices that may themselves be inflated. If you're finding this useful, go ahead and hit that like button. It really does help this channel reach more people who are trying to understand these ideas. And if you haven't subscribed yet, we talk about these kinds of macro concepts regularly in plain English here on the John Smith Oro 2 channel. Now let's keep going, because I want to make this really practical for you. Let me tell you about a mental framework that some investors use to think about this kind of situation. It's called the real asset ratio approach. The idea is simple. Instead of asking, what is the dollar price of this asset? You ask, how does this asset compare to other real things? So instead of asking, is a house expensive? You ask, how many ounces of gold or silver does it take to buy that house? Instead of asking, is silver cheap? You ask, how many barrels of oil or square feet of real estate can an ounce of silver buy? When you start thinking in ratios instead of dollar prices, patterns become clearer. Mispricings become more obvious, and potential opportunities for rebalancing become more visible. This isn't a perfect system. No system is. But it's a way of stepping outside the dollar-denominated bubble that most financial thinking lives inside. Here's a real-world way to think about this. Let's say you're a working professional in your late 20s or early 30s, and you've been trying to buy a home. You're watching home prices in your city, and they seem completely out of reach. The median home in many U.S. markets is well over $300,000, often much more. And you're wondering, is now a good time to buy? Should I wait? Should I keep renting? Those are entirely valid questions, and there's no one-size-fits-all answer. But here's an additional lens to consider. If housing prices soften over the next few years, as many analysts believe they will, and if silver prices rise meaningfully due to the industrial and monetary demand we talked about, then the purchasing power of silver holders relative to real estate could increase significantly. That's not a reason to skip buying a home if you're ready and it makes sense for your life. But it might be a reason to think about whether holding a portion of your savings in silver makes sense as a bridge strategy while you wait for the right opportunity in housing. Again, this is just a concept to explore with your own financial advisor, not financial advice from me. Now, I want to be honest with you about the risks here, because any responsible discussion of this topic has to include them. Silver is a volatile asset. Its price can swing dramatically in short periods of time. In 2011, silver hit nearly $50 an ounce and then fell to under $15 within a few years. Anyone who bought at the top and needed that money in the short term was in a painful situation. So silver is not a short-term trade. It's a long-term thesis, and it requires patience and emotional discipline. Real estate, meanwhile, is not going to zero. Even in a correction scenario, housing in desirable areas tends to hold value over the long run. The forces that keep housing expensive, limited land, population growth, inflation in building costs, are real and persistent. So we're not talking about a collapse of real estate. We're talking about a gradual rebalancing of the ratio between silver and housing. And gradual rebalancing can take years. There's also the question of whether the traditional relationship between silver and real estate even holds in the modern financial environment. We now live in a world of derivatives, exchange-traded funds, digital currencies, and algorithmic trading. These things change how markets behave. Silver, in particular, has a massive paper market, meaning futures contracts and other financial instruments that dwarf the physical market in terms of daily trading volume. Some analysts argue that this paper market suppresses silver's price in ways that the market can't sustain indefinitely. Others argue that the paper market is simply a reflection of modern finance and will keep silver in check for a long time. This is a genuine debate among experts, and reasonable people disagree. So I want you to hold the ideas in this video as a framework for thinking, not as a blueprint for action. What you can do practically, and this is where this gets personal, is simply start tracking the ratio. Look at the current price of silver. Look at the median home price in your area or in the area you want to buy in. Divide the home price by the price of silver per ounce. That gives you the silver to housing ratio for your specific situation. Then track that number over time. Watch what happens to it as markets move. You'll start to develop an intuitive feel for when that ratio is historically high, meaning silver is cheap relative to housing, and when it's compressing, meaning the two are coming back toward balance. This kind of tracking builds financial intuition, and financial intuition, built over time through real observation, is more valuable than any single tip or prediction you'll ever hear. It's also worth thinking about what a 2026 pivot would actually look like in practical terms for everyday Americans. If the Federal Reserve begins cutting rates meaningfully, you'd likely see money flow back into risk assets, stocks, real estate, commodities. Silver tends to do well in that environment. If the economy weakens and credit tightens, you might see real estate soften in certain markets, particularly the markets that saw the most dramatic price appreciation during the pandemic boom years. Secondary cities and suburban areas that saw enormous price spikes may give back some of those gains. Meanwhile, silver, as a safe haven asset, could attract capital from nervous investors. So in either scenario, soft landing or harder correction, silver has potential tailwinds, while housing faces potential headwinds. The question is magnitude and timing, and that's where even the best analysts are working with uncertainty. One thing that's genuinely interesting about the current moment is the growing mainstream recognition of silver's dual role. For most of the last 20 years, silver was primarily seen as a speculative play for precious metals enthusiasts. But the clean energy transition has changed that narrative in a meaningful way. Every solar panel contains silver. Every electric vehicle uses silver in its electronics and battery management systems. The U.S. government and governments around the world are committed to expanding solar and EV infrastructure dramatically over the coming decade. That creates a structural, non-speculative demand floor for silver that didn't exist before. Industrial buyers need silver whether the price is $30 or $60 an ounce. They can't substitute it out entirely. This gives silver a demand dynamic that is fundamentally different from what it had 20 years ago. And it's one reason why many analysts think the suppressed price of silver relative to real assets may not be sustainable indefinitely. Here's the broader philosophical point I want you to walk away with. In a world where the currency is managed by central banks who have shown a willingness to expand the money supply dramatically when economic conditions require it, the concept of pricing things in dollars becomes increasingly unreliable as a measure of real value. Real estate has long been one of the primary inflation hedges that regular Americans have used, their home as a store of value. But real estate has its own challenges. It's illiquid, it's expensive to maintain, it's subject to local economic conditions, and it's increasingly unaffordable as a first purchase. Silver offers something different: liquidity, divisibility, portability, and a long history of holding real purchasing power across different monetary regimes. It's not a perfect asset, nothing is, but it plays a unique role in the spectrum of wealth preservation tools available to people who aren't billionaires. The silver-to-housing ratio is simply a way of asking, relative to the most important financial asset most Americans own or aspire to own, is silver cheap or expensive right now? And the data, viewed through the lens of historical norms, suggests that silver is near historically cheap levels relative to housing. That's the core insight. And the 2026 pivot, whatever exact form it takes, is likely to be a period of significant reassessment across asset classes, which could be the catalyst for that ratio to begin normalizing. How far and how fast that normalization happens is genuinely uncertain, but the direction of the pressure seems clear to many who study this carefully. As we close out today, let me give you 3 simple things to think about. First, start thinking about prices in relative terms, not just dollar terms. Ask yourself what assets are cheap or expensive relative to each other, not just relative to last year's price in dollars. Second, educate yourself about silver, not just as a commodity, but as a monetary metal with a centuries-long history of preserving wealth. Understand its industrial demand story and why the clean energy transition matters for its long-term demand picture. Third, watch the 2026 macro environment carefully. Pay attention to what the Fed does with rates, what happens to housing inventory and affordability, and what silver does relative to both. You don't have to make big decisions. You just have to stay informed and think clearly. The most powerful thing any investor can do, especially an everyday investor who doesn't have access to fancy Wall Street research, is to understand frameworks that help them see what others are missing. The silver-to-housing ratio is one of those frameworks. It's not magic. It's not a secret. It's just a different way of measuring value that most people don't bother with because they're too focused on the dollar price of things. And sometimes the edge is simply in asking a different question than everyone else is asking. Today's question is, how many ounces of silver does it take to buy a house? And tomorrow, that question might lead you somewhere very interesting. Thank you for spending this time with me today on the John Smith EO2 channel. If this video gave you something to think about, share it with someone you know who's navigating these financial questions. Leave a comment below. I genuinely read them, and I'd love to know what you think about the silver-to-housing concept. Until next time, stay curious, stay informed, and keep thinking for yourself.